Ladies and gentlemen, very happy to have a very wise man in our channel today. And in the midst of all this turmoil and crisis and uncertainty, I've got a really wise man. His name is Christopher Tan. Everybody knows him. Okay, thank you, sir, for coming.
No, thank you for having me. Hello, everyone.
Yeah, okay, now we'll cut to the chase. In these kind of times right now, are you a lot more busy? Are people calling you right now? Wow, sell, 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 or buy, 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 buy? I don't know.
No, thankfully, no. I mean, firstly, we don't manage money this way, and our clients are pretty well trained, so they don't react this way. Plus, I think, fortunately or unfortunately, we sort of have gotten used to all these news of wars ever since the war between Ukraine and Russia broke out, right? And then one after another. So, no, I would say that life is pretty normal for me.
Wow, it's quite sad, right? To think that war has become a normal
Sad.
news now.
Yes, sad.
Very sad, right?
Mm.
Okay, so now I actually pre-prepared a set of questions, but circumstances and situation have seems to change. We now seem to have what I call Asia financial crisis 2. Okay, right now we are seeing stock market across Asia, in particular Korea, massive stock market crash hit circuit breakers. Thailand, same thing. Even Japan and Taiwan having 4% market crash and so on. Even Singapore, is the invincible DBS OCBC also seems to be hit. What's your take on all this? Is it some big crisis now brewing? I know US market is pretty shielded, and seems like Asian market is being hit. Now, what's your take on the whole thing?
I think it's just normal. I mean, people are just reacting to the fears in the market. I wouldn't really call this a crisis as yet, right? I mean, for you and for me, we have gone through real crisis, not just the Asian financial crisis in 1997, but, well, I will never forget the crisis in 2008, right? Markets kept coming down for a period of 3 months. I mean, this is just starting. So I wouldn't really call this a crisis. And obviously, people are reacting to the news that's happening in the Middle East. People are afraid that oil prices may go up. And as we all know, if oil prices go up, it affects business costs. And of course, that affects the profitability of companies. And people are reacting. And we all know also that generally emerging markets are usually more volatile than the developed markets. So I don't think really there is, I mean, unless you're a market timer, you are always trying to find the best time to get in and out of the market. I don't think we should be too worried about what is happening in the Asian markets today.
I see. But the truth is, when the viewers, investors across my channel, be it in Singapore or Malaysia, when they look at this news of war, oil prices being hit, Straits of Hormuz being shut down, and things like that, it drives fear and it drives certain kanchongness, and sometimes it is very concerning. So, from my experience over the decades in the financial world, what is the best advice to us getting concerned to the point of worried or even panicking? What's your best advice for us to do now?
Yeah, I think, I mean, we always say that we cannot control our feeling, we cannot control our emotion, but we can control our response, right? And this is not the first time the world is experiencing this. Although I would say that I think, Lou, between both of us, right, over the last 5 years or so, this has become a lot more intense. And perhaps that's because of the administration that is governing US right now is a lot more aggressive, and they don't hesitate in using the military to get what they want. But otherwise, if we look at history, I mean, it's not the first time we are experiencing wars. It's not the first time we experience oil prices becoming expensive. I mean, we last checked, it's really not that expensive yet, right? But I remember, I think it must be in the 70s or 80s, we have oil prices going up very high. So it's not new. So I would say that for investors, right? If you are a long-term investor, and I'm going to say something that will make this podcast really, really very boring because I really don't have anything new to say. If you have a job, be thankful, keep your job. That's very important.
Very important, don't suka, I'm not happy with my boss, change the job,
Yeah, because I mean, if you have a job, you are actually an income producing machine, right? And so as long as you earn an income, really, you don't really have a lot of things to worry about. And that's why I think we always emphasize, and I always emphasize in keeping yourself financially healthy, keep your debts low, spend below your means, you have surplus, These things are not going to cause you to have sleepless night because financially you are okay, you're not overly in debt and you still have income coming in. Now, if that part of you is taken care of, and if you are invested, then I'll say don't go and look at all this short-term volatility. If you are invested in a globally diversified portfolio, you're not just buying individual stocks, you're not narrowly concentrated, then you can sleep in peace. This too will pass. Invest for the long term and the returns will come.
Wow. Okay. So by the way, yeah. So even the wise man like him, 10 times, 100 times wiser than me is using the phrase globally diversified portfolios. Okay. So actually, I copy from them. Okay. He and Mr. So Chining both very wise. Okay. So now let me just expand on this question a little bit. Right now, seems like, if I would analyze, it seems like an overreaction from the Asian market. As I see US very very steady, but now the US, the Asian market, I just saw the Korean market close at, I think, a 12% down. That's I actually never seen a market that closed at 12% down. I would consider Korean market, I thought, in my opinion, pretty, it's not a new market lah, like Papua New Guinea or Zimbabwe or something like that. No, for you to crash 12% is quite a big thing. But I think what they're really afraid of is the if the conflict escalates and the oil prices will start to spike in a phenomenal way and logistics will go up and things like that, then maybe this would have a whole chain of effect coming up. Maybe their exports get hit, inflation get hit and things like that. There are probably anticipation in a possible scenario. So right now, what should they, what if those scenario happen? What you do, what you just said, will it change?
No, it won't change.
Yeah.
Yeah, I mean, it won't change, right? Because ultimately, we need to know what we are investing. We
Mm.
are investing in the long-term profitability of companies. You are invested in equities. That's what you are banking for, right? You are banking for companies continue to make money in the long term because that's where you get the returns when you are investing in the stock market. And if you are investing for a long term, I mean, we cannot expect the world to be peaceful over a 10 to 20-year period. So you're going to expect this kind of geopolitical risk, wars, terrorism, natural disaster, right? But like I said, if you still believe in returns coming from investing in equities, I'm not going to care too much about the short-term volatility. I'm not going to worried too much about all these wars, right? This administration will come, this administration will go. There will be a new president. Maybe the world will continue to be this aggressive, right? But I mean, like I said, unless you think that from now on, no company is going to trade with each other anymore. From now on, I've got no needs. I don't need to buy a handphone anymore. From now on, I'm going to produce my own vegetables and eat. No, no, right? As long as consumers continues to have needs, as long as consumers continue to have demand, companies will be there to deliver those demands, to supply those demands. And companies will continue to make money in the long term. As long as you believe in that, then I'll say ignore the short-term volatility that are caused by these news and stay focused in your long-term strategy for your investment, right? So that's what I will encourage you. And of course, whatever I say, the caveat is you are invested in a globally diversified portfolio. Because if you are investing in single stocks, then whatever I said may not apply because the company that you invest in can actually go bankrupt and die.
That's quite frightening. No, I just want to say right now, there are many of retirees or near retirees. No matter what we say, they bet on the familiar names, DBS, OCBC, Singtel, and all this. And right now, I'm looking at it. Wow, came down quite a lot already. Came down quite a lot, 10% ish, maybe even more coming. They're very worried now. So no matter what you say, wow, no, don't worry. But I'm still kanchong. I'm still going, what do you do what do you tell these people that are still very kanchong?
Yeah, I mean, I cannot, like I say, stop you from being kanchiong. Actually, look, regardless of what we say, I don't think we would be able to assure clients from not being worried,
Mm,
right?
mm,
Like I said, the only thing that I can tell you to do is to choose your response,
mm,
right? So I'm not going to tell you to go and sell your positions because if you go and sell positions, then you are going to lose money. right? And like I said, I really got nothing new to say. I'm a very boring investor,
But
and
boring is good because it makes money.
um, eh, yes, over the last decade, we have been making monies for clients,
Mm,
right? And my clients know that we tell them the same thing all the time, but the same thing that we tell them, I know is not easy to do, lah.
mm,
And I'm going back to the same thing as make sure that your financial health is strong, make sure that you got enough emergency fund. If you're still working, make sure you still have a job. Keep
mm,
that foundation very strong.
mm.
And then if your strategy is very concentrated in a few stocks, maybe consider instead of being concentrated in a few stocks, maybe consider to redirect your investments into a globally diversified portfolio. Then you don't have to worry, right? You don't have to worry about that one company that goes down. Then you don't have to worry about which region will do better and which region is going to do not as good. You don't have to worry, right? So that's what I would say.
Very good. Okay. Now, talking about globally diversified and concentration whatsoever. Now, this is something that always come out and recently came out a lot. Even my son has been talking about it to me. I've always been a big fan of S&P 500, Nasdaq whatsoever. But given nowadays we have got a US president that is a bit more off tangent
Mm,
or unusual,
mm,
the world is now fearing that US becoming unreliable,
mm,
not just from a trading partner perspective, as a
mm.
destination of investment, and so on. So, is it time that we now look into diversifying out of US into more non-US
Mm,
kind of asset? Because really, people are really more having less trust in US right now.
yeah, so I think, Lou, you know me. Whilst you are a great proponent of S&P 500, and I'm not a detractor, but I've always been saying that we should always be diversified,
Yes.
right? Now, yes, history has shown that if you stay invested in the S&P 500 for the long term, you are going to get the returns. You should not lose money.
Mm,
That's quite clear from evidence. However, positive returns do not mean enough returns.
mm,
So if you invest in the S&P 500, and there have been periods in the S&P 500 that the returns are flat. Now, yes, you stay invested for a long term. You are not going to lose capital,
sure.
but the returns may not be sufficient. Right? That's one. Secondly, I know that the S&P 500 has done very well over the past 100 years,
Mm,
but there's no guarantee that the S&P 500 will continue to do well in the next 100 years. Nobody can say with certainty
mm,
that something that has done well in the past will continue to do well going forward.
mm,
So I've always said that the S&P 500 is not a silver bullet, right? And since day one, we have never taken that stand. We have always asked our clients, I've always said that you should be globally diversified. So
mm,
in those periods when the S&P 500 are not delivering the returns, your diversification into other developed markets and even into the emerging markets will give you the return. I actually written an article on the Business Times, I think last year or the year before, on this. And there's one more thing. The other thing is that if you are investing in a single country index, you have to be prepared to accept a higher volatility, right? If you only
like
invested,
Korea now.
yes, right? If you invest in Korea now, you'll be so devastated, right?
Mm,
If you are invested in the emerging markets, right, you're going to be so devastated because it's
mm,
very volatile,
mm,
right? So if you are invested in a single country index and it can be the S&P 500, then it's going to be a lot of volatility. Now,
mm,
even if it still holds true, the next 10 years, 20 years, the S&P 500 is going to give you outsized returns.
mm.
But if the volatility is so great, right, Lou, you may not be able to stay invested and you get out of the market. And
Then you
even
lose
if the
money.
returns come, you're not going to capture that returns and you may
Sure.
even lose money. So being globally diversified, I think is a very smart thing to do because if not for anything, it is diversified enough such that the volatility is not too great that you will jump out of the market. It helps you stay invested that when the return comes, you can capture the returns. And this one last thing I will say about this is that, of course, if you are invested at once maximum returns, diversification will not give you maximum returns.
Mm,
Right? It's always better to go and bet on a single country, bet on a single security, then you have a chance to get the best returns.
mm.
But if you're an investor, and I think most of your community members are like that,
Yep.
they just want to get enough returns to fund the lifestyle that they want. And I think being globally diversified will do the job for you. Right?
Mm,
So yes, to your question, and I know it's a very long answer to your question. Is it time? It has always been time.
Mm.
I don't think this is like this is time now to diversify away from US. I will say that it has it should be done this way since day one.
A slight expansion of my question.
Mm.
Now, it's arguable that S&P 500 companies are all global in nature anyway,
Yes, that's right.
right? So isn't there some kind of innate diversification already globally?
Yeah, of course. But well, like it or not, they are the S&P 500. They are like your top 500 companies or the biggest 500 companies in terms of market capitalization in the US stock market.
Mm.
So yes, they are already quite diversified across the 500 companies. Yeah, but why ignore the rest of the companies that are in other markets, right? So yeah, you want to improve your diversification in other companies as well. Plus, of course, there is this question of foreign currency, right? When you buy the S&P 500, I mean, you are buying the US stock index. Ultimately, you need US dollars to buy the US stock market, right? And well, before we did this recording, we did have a chat a little bit about
Yeah,
de-dollarization.
that's a big fear that everybody have. Right? Will US dollar come down from 127, 128, 28 to all the way to 1 to 1?
Yes. I think firstly we need to define de-dollarization. The word de-dollarization simply means that there is the loss of confidence in the US dollar being the reserve currency or being the dominant reserve currency, and there is a lesser reliance on the US dollar. Right? And a lot of people are worried about that, especially it seems like the central banks are actually loading up more gold, right? And people are thinking that are they abandoning the US dollar as a reserve currency? And if so, then the US dollar will continue to weaken. And if I buy stocks from the US stock market, even if I make capital gains, they are afraid that the FX will kill them. But I think one key thing that, in fact, last week we were just talking to our clients during our annual client event about it, that please do not be mistaken that the weakening of the US dollar means there is de-dollarization. I mean, there are many, many reasons for the weakening of the US dollar. I mean, it could be interest rate, it could be perceived strength of the economy, it could be many, many reasons,
Or
right?
just not happy with Trump? Whatever.
Yeah, whatever. I'm
Cannot
not
tell.
sure. Yeah, but so actually, just a few months ago, my team actually did a very thorough study and wrote a paper that we sent internally to our clients about this topic on de-dollarization. We look at many, many different data set. Okay, I'm just going to share one data set, right? We're going to look at what the paper said over here, right? There are many, okay? I'm just quoting one. And they are looking at payment system. Right, so the two big payment system, CHIPS, which is the Clearinghouse Interbank Payment System, and the other one is CIPS, which is CIPS, Cross-Border Interbank Payment System. So if you look at CHIPS, right, and you can look at my data,
Yeah.
the daily value process, US dollar, is 1.8 trillion in 2022. And come 2025, which was just last year, the daily value process is 2 trillion. So it's
It's gone
even
up.
higher, right?
So US transaction is gone up.
Yeah, so you don't see a lesser reliance on the US dollar.
Okay.
SIPS, the daily value process, a different payment system, is US dollar 61 billion in 2022, and last year it was 97
Oh,
billion.
gone up by
Right.
50 over percent.
Yeah, and this is just one data set, right? And it shows you that, well, people are still actually relying on US dollars to trade.
Heavily.
And another thing that I think my investment team looked at and was communicated to our clients is that, well, even if de-dollarization is going to happen, we don't know, right? But even if it's going to happen, history shows that something like de-dollarization will take a long time. I mean, the world has not gone through many frequent changes of reserve currency, and the last reserve currency, the last dominant reserve currency was the British pound. And it actually took about 20 years before the US dollar, in a way, overtook the British pound significantly. So I don't think that de-dollarization is going to happen like overnight. Is it going to happen? I think it's anybody's guess. It may, but in order to avoid that FX risk, right? Then I'll say again, diversify. You don't just invest your money in the US stock market, be globally diversified.
So maybe talk about diversification. We always talk about diversification across geography. Now that you've given a very good view of it, now let's talk about diversification across assets. Now, I'm a big fan of stocks and shares, and to some extent, I believe in property as a diversifier as well. But recently, there's one big attraction: gold,
Gold, yeah.
gold, maybe even
Yeah.
oil, right?
Yeah.
So gold is a big topic everybody is talking about. Even my wife was saying, you stupid. Last time I buy a lot of gold chain, gold jewelry, you can't be kabu. Now you see everything that glitter really got money. It's like quiet now, bopian. What's your perspective of diversification into these assets?
Yeah, so again, we did a study over the last few months on gold as an asset class, right? And well, just to be transparent, we never had gold in our Providence portfolio. And the reason is because at Provident, we look at gold as an insurance, right? We never look at gold as an asset class that will give you the returns that you need. And again, from data and again, various set, I'm just going to quote one. Over the last 30 years, we found that the annualized return from gold is about 5% per year. It's not great. It's not bad, but it's not great, right? I mean, your CPFSA is 4% per year,
Yeah.
right? But this is 5% per year, right? And then if you look at equities return, right? The average return of equities return over the same last 30 years was about 10% return. So you can see that equities actually has done a lot better than gold. And in terms of volatility, they are about the same. I think the volatility of equities, if I can remember correctly, is about plus minus 20%. Whereas for gold, it's about plus minus 15% over the last 30 years, right? So you realize it's about the same. So if we had put gold into our portfolio the last 10 years, the returns for our clients would have been muted because, well, the more money you put in gold, the lesser you have in equities, the returns won't be that good,
Sure.
right? And we didn't put money in gold because 10 years ago, all these risks that we are talking about today, geopolitical risk, de-dollarization, all that, it wasn't present, right? And so if it's not present, then why you buy gold? But today, I think when we are looking at where the world is
The
today,
world is different now.
I think that we need to be more concerned about some of these risks that may really pan out over the next 10, 20 years, right? So we're beginning to consider putting gold, a bit of gold into our portfolio as insurance, right? And of course, we have expected some of our clients to ask things like, oh, why buy gold now? I mean, why don't buy gold like 6 months ago when it has not risen yet, right? Well, firstly, we don't know, right? Not market timers. Secondly, the reason why at Provident we are thinking about putting gold in our portfolio is not a tactical decision. It's not a speculative decision. It is more a strategic long-term decision. So if we're going to buy gold today, it's going to be there in the portfolio for the long term, right? And the last thing I want to say about gold, and we had this chat earlier on, is because we look at gold as an insurance, and we always say insurance is an expense, you only buy an insurance when the risk is present.
I see.
Right? So illustration, Lou, you are 20 years old today, no children, not married. Your risk of losing your income is low. Or rather, if you lose your income, the impact you have on your dependents would be low because you have no children.
Exactly.
Right? So even though insurance could be very, very cheap today, you don't buy it
Buy
because
for what?
you have no risk, right?
Yeah.
So you save the money and you might as well take the money and go and invest instead of paying insurance premium.
True.
Right? 15 years later, you are married and you have 3 children, and now there's real risk. If you lose your income, it's going to impact your family, right? Now, even though your insurance premium is more expensive 15 years as compared to 15 years ago, you buy it because the risk.
We need it.
Yes. And you have saved 15 years of premium for not buying insurance where you
Exactly.
don't need it, right?
Yeah.
So, well, 10 years ago, we didn't buy gold. It was a good decision because we made the returns from equities, it was better.
Sure.
But today, if the risk is really present and you think you need to buy insurance to protect your downside risk, then yeah, you buy it regardless of where you think the price is because you are buying it strategically, not because of tactical decision.
Very good. Very good. Okay. Now, looks like it is a very wise advice to think about gold as an insurance. Okay. So just to wrap up, right? What's your parting advice to everybody in the light of turmoil and everything?
Yeah, I'm very boring. I say the same thing all the time. And I shared this before. When I was running Provident in 2008, right, we started in 2001, and then 7 years later, the GFC hit. I was stressed. I was very stressed, right? And at that point in time, I was staying in a private property. If I don't remember wrongly, I had 2 cars, and the company portfolios were coming down, right? So your company is not doing well, the revenue is affected, and personally, I'm so afraid that I'm not able to pay all my debts, right? And it was a very, really stressful period. Come 2010, I did a decluttering. I live a much simpler life. I moved back to public housing. I cut down the number of cars to one. Um, and today, when I'm going through this current crisis, I am very rested because I'm not afraid about this short-term volatility, the drop in revenue, because financially I'm very, very healthy. And all the more now because my children, they are all grown up, they are all working, earning their own income. I don't have to support them anymore, right? So that gives me peace of mind. And when we have that peace of mind, we make better decisions. I don't have to make stupid decisions that will affect my clients just because I'm so afraid that I cannot pay my debt. I won't make stupid decision just because the stock market is so bad. I'm so afraid I don't have money. I'm going to sell out all my shares. I don't have to, right? I can keep my view for the long term because in the short term, I am fine, right? I know the world will be fine, right? So that's my encouragement to all of us. It's never too late. It's never too late. If you are going through this and you are feeling very uneasy, I think it's good to ask yourself, why are you feeling so uneasy, right? Is it financially your foundation is not strong? Right. So I say this is a good time to relook into your financial and see how you can actually clean up and then have a very strong foundation so that you can have that peace of mind.
Thank you. Right, ladies and gentlemen, this is Christopher Tan, CEO of Providend, and we're very fortunate for him to share with us his wisdom in a time of crisis. So thanks again, Chris, for coming to our channel.
Thank you. Thank you for having
Okay,
me.
well, with this, thank you everybody for watching, and I'll see you probably in my live stream or my video again. Bye bye.
Goodbye, guys.
Bye bye.